here to continue, Steve, and it boils down to the challenge over funding the deficit, which means new debt issuance, more supply, higher yields, the feedback loop that takes us to 5% then on the 10-year yield, if not higher. That's going to be deeply problematic for consumers, businesses, the whole economy and capital markets.
Well, I'm not so sure that to shut down the government takes yields higher. I mean, I don't, first of all, if you suddenly have a shortage of paper for a certain amount of time, that actually would have downward pressure on yields. And if this shutdown actually certainly isn't a boost to the economy, I mean, I don't think it's much of a negative, but if you had to put it marginally on one side or the other, it's marginally negative. And again, we are teetering towards recession here, not yet there, but teetering in that direction. And that also would cause yields to fall. And the idea that, well, who's going to buy 10-year yields and who's going to buy the paper, it's not really an issue. We want to talk about 25, 50, 100 years from now, whether, it's an issue. It's a different conversation. But, if we're talking in the near term here, a buyer's strike, I mean, we send out 5% at least of our GDP every year net in terms of buying more from the world than what we produce. It helps the rest of the world grow. And in return, they get dollars, which they have to buy in assets. And so the rest of the world has decided that that's a pretty fair trade for them.
Stephen, does it follow that a shutdown, if that did materialize, would trigger a downgrade on the sovereign credit rating of the United States? And if so, just how destabilizing could that be?
I don't think it's very destabilizing at all, because I don't think it means very much. I think, politically it is, and it's a talking point and all that stuff. But let's take a step back. Everything in the world is priced off of zero-risk treasuries. And treasuries are not going to default, and the government's not going to default. And there is no substitute. So everything is priced against that. So if you downgrade and say, for example, I'm just going to be extreme, if you downgrade the U.S. government debt and say it's junk credit, which it's obviously not, but say you liken it to, Greek bonds or something, I don't know, pick your country. That means you've also downgrading every financial institution in the world because they all own dollars. And that means the asset side of their balance sheets are similarly reduced in quality. And where are they going to go? I mean, what are they going to do to replace it? The dollar is still the main means of currency for transactions. We're still the biggest economy in the world. And, in Europe, you're not really producing high-quality debt because the Germans would be German debt, but they've been running a deficit, and they're going to swing back to a surplus or balance. The Japanese don't want to take outside capital, so the BOJ buys the debt. And does everybody in the world really want to, in terms of other central banks and everybody else, just trust the Chinese with their money?
Yes.
Go ahead. So, I don't, like I said, a lot of this stuff, if we want to talk about longer term implications and things, that's a different story. And I think it's a story that has some credibility to it longer term.
Yes.
But short term, not so much.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.